Thursday. Today we're talking with Tom Bowley of EarningsBeats.com. We'll talk about earnings season, the S&P rolling over going into the close, back down to 3,900. Ladies and gentlemen, this is the final bar. Hello, everyone, and welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets. Using the power of technical analysis, the technical toolkit was described to me as I was just learning about the markets, learning about investing. A couple of years ago, I was taught that technical analysis really helps you understand what investors are thinking. There's a psychological concept or psychological overlay, I think, to what we do as technical analysts, focusing on price, focusing on the information that price and momentum and trend provide back to us. At the end of the day, I think we're getting inside the head of other investors, many of which, if not most of which, react irrationally and emotionally to what's happening in the markets. Now, we are in sort of the petri dish of emotional reactions. Earnings season, when you have big moves to the upside, big moves to the downside, a lot of expectations that get magnified or crushed moment to moment. We have Netflix here reporting after the close today. So a lot of things, a lot of charts to unpack, a lot of charts to uncover. A great guest today, Tom Bowley. We'll talk to him here in a little bit. But first, we need to recap what happened in the markets today. Let's look at the charts. You can see the S&P 500 finishing down about 0.75%. And again, it's sort of a weird, sort of choppy day today. We made the low for the day just before lunchtime Eastern time. But at the end of the day, instead of that rally going into the close, which is often the sign of institutions doing buying into the close or some sort of encouraging development in the last half hour, the opposite occurred today. The opposite occurred yesterday too, right? On a big down day, you had an acceleration into the close. Yesterday, same thing today. So the S&P, instead of getting above 4,000, which is where we traded above on yesterday's session, today we're actually closing right about at 3,900. That puts the S&P down about 0.75% from yesterday. Mid caps and small caps down as well, with mid caps leading the way lower, and the NASDAQ 100 down about 1% as well. So sort of that mega cap trade, which mega cap FANG trade, as I think the NASDAQ 100 pretty well captures, leading the way to the downside. The VIX, by the way, continue to push up. So through the course of the week, while you've seen risk assets, especially equities, move lower, we've seen volatility start to increase. Now, one of the question marks, I think, going into this week was, do you have a sustained advance, right? Do we continue through 4,000, 4,100, continue this follow through to the upside with volatility breaking down or volatility lessening, which would be more of a sort of slow and steady accumulation phase? We're not getting that message this week. We're getting the market pulling back from resistance. We're getting volatility increasing again. And, different ways you can describe the VIX. It's a measure of volatility, but it's been called the fear gauge. I think the uncertainty gauge is probably more accurate in terms of what it's actually trying to measure. But market moving down with increasing volatility basically tells you that there's uncertainty and it's not going away. It's actually increasing right now. Bond market's going down as well. So you had one of those days where stocks and bonds both moved lower. Yesterday, if I remember right, you had stocks down and bonds actually had a pretty decent day to the upside. Today, the opposite. We have rates going back up, 10-year yield around 3.4%, long bond yield getting nearer to 3.6%. The dollar index down a little bit, about 0.25%. So not a huge move to the downside. We've talked about that gold and precious metals trade for quite some time. When we had our market outlook last week, which Tom Bowley was one of our panelists, we had a really fun time discussing a lot of different things. But there was a focus on commodities I was not prepared for when we went in there. As we talked, we sort of focused more and more on the commodity space, and gold and silver were some of the things that came up in the course of that conversation. The chart of the GLD pushing to the upside with the with gold actually up 1.6%, silver up 1.8%. Cryptocurrencies for the most part in the green, although Bitcoin and Ethereum have both pulled back from highs in the last couple of days. Bitcoin up almost 2%, with Ether up almost 3% today. Let's look at a chart of the S&P 500, sort of check in on where things are at. I was doing an interview yesterday with my friends at IBD at Investors Business Daily. Had a really good time with Justin and Arusha. The podcast should be out here pretty soon. And we had a great discussion about a lot of things, about routines, about behavioral biases, but a lot, of course, about charts. And when we talked about sort of the big picture environment for the equity markets, you know, what I sort of told them was a number of sort of maxims that I've been taught, trading maxims over the course of my time following stocks here pretty closely. Things like nothing good happens below the 200-day moving average. Things like once is chance, twice is coincidence, three times is a pattern, which is a reminder that trend lines that you test not once or twice, but three times, four times, five times, now six times, all of those tests of that same trend line, I think, reinforce the value of that trend line as a visual representation of the pace of this trend. As long as we keep coming up and testing that trend line, but failing to break through it, it tells you that is a pretty good measurement, pretty good measure of the pace of this downtrend. As long as we keep testing that, and as long as we don't break above that, how constructive do you really want to get about things? But it also tells me if and when, and I would say with equities, it's more likely when than if, of course. At some point, we most likely make new highs for the S&P 500. I don't know when exactly that will be, but I do know before we get to S&P 5,000, we have to get above S&P 4,000. That's how the math works. So until we get above that trend line, the trend is still down by definition. So this last week, testing once again trend line resistance, failing to get above the 200-day, stalling out here at 4,000. One of these rallies is going to complete all of those check marks that we were not able to check this time around. And for me, that's one of the great indications, I think, to look forward here, most likely through the course of 2023, maybe sooner rather than later. Looking at sectors here very quickly, you see energy number one. It's another area that we've talked about many times in the last year, certainly in the early first half of 2022, when you had energy just completely an outlier from the rest of the equity space. Been a little more choppy, right? But at the same time, you have charts like SLB and Hess and others at or near all-time highs. Consolidating certainly in the last couple of months, but all of a sudden starting to rotate back. Some of those actually making new 52-week highs here in the last week. So energy number one today, communication services number two, and then healthcare number three. Those are the only three S&P sectors that actually finished in the green. Everything else going lower. Industrials leading the way to the downside, down just over 2%. Consumer discretionary, the XLY, down 1.7%, followed by financials and technology, both down about 1.2%. What I wanted to do next was just check in with our Mindful Investor live chart list, particularly looking at some measures of breadth. Breadth measures, of course, the major indexes, the broad charts tell you about the overall conditions that the market that is reflected in the price of an index, right? Take all the price movements, aggregate those movements into an index of stocks. That's what Charles Dow told us, 100 plus years ago, was a great way of measuring the strength of the economy, essentially. But measures of breadth sort of look underneath the hood, and they tell you what sort of participation we have in these uptrends. A lot of the breadth indicators have turned incredibly positive here in the last 6 to 8 weeks, coming off the October low. And again, off the June low, off the March low last year, a lot of times you had these rallies and the breadth conditions never really got too crazy positive. But what happened here in December and then into January in the new year, all four of the advanced decline lines for the New York Stock Exchange, for the large cap, mid cap, and small cap indexes, those are the four series top to bottom. All four of those have already broken above the their December peak. So while the S&P has failed to get above its November, December peak, these four measures of breadth actually have. And what does that mean? That tells you that the underlying stocks that comprise the index, because these are equal weighted measures, there's more strength under the hood than probably the chart of the S&P may imply, right? Because it is very much geared toward the mega cap names, the Microsofts, the Apples, the Netflix. Not all of those, the Alphabets, not all of those have been particularly attractive charts or outperforming recently. As a result, our growth-oriented mega cap tilted benchmarks are remaining a little more muted than the individual stocks that comprise that. And we've seen that by the fact a lot of individual names have actually looked pretty constructive off the for the last 6 to 8 weeks, while the major benchmarks have failed to follow through to the upside. What's interesting when you just think about the market history that we've experienced in the last 6 months or so, the June low was a meaningful one, and we know that, right? By any measure, even at the time, you could see that there were some things happening. Some very well established technical analysts like Tom Bowley, our guest, did a great job of making noise in June. of last year that a bottom was likely. We then saw a rally, but what's interesting is look at what happened at the August high. The S&P failed to close above its 200-day moving average, but these advanced decline lines all made a new high. It's a very similar configuration to what we're seeing here, except the fact that the S&P actually made a new high in August. Here we actually have not had that situation, but just because breadth is making a new high doesn't necessarily mean an all clear. It doesn't signal that everything's great. It just tells you, in my opinion, that there are a lot of individual stocks worth paying attention to and worth following. The challenge we have this week is a lot of those names that have had pretty good runs, something like airlines, for example, having some choppy days. Some of them recovered a little bit today, but overall really felt the pain through the course of this week. Something like United Airlines comes to mind, sort of pulling off those previous swing highs. Another one to look at, and this is one because it just was getting worse going into the close, is the percent of stocks above their key moving averages. Here we have the S&P. Then we have the percent of stocks above their 200-day moving average in blue, the percent of S&P stocks above their 50-day moving average in green. As of today, we went just below 50%. Now, just barely, fair enough, it's 49%. So at this point, it's half and half. You pick a stock at random out of the S&P 500, coin flip whether or not it's above or below its 50-day moving average. So while that's not exceptionally bullish, that's certainly not crazy bearish. That's not telling you it's the end of the world. Worth noting here, when we pulled back in late December, both of those indicators bottomed out right at 50%, but they didn't break much below that. And that was a great indication that the pullback in December was temporary, that there's enough underlying strength to push the markets higher. Do we get a similar move this week and next week? Do those breadth indicators hold at the 50% level? Folks, we need to take a quick commercial break. We'll be back with today's guest, Tom Bowley. We'll see you in a minute.
What if you could look beyond price and identify big moves in the market before they happen? That's why we created the Moxie Indicator Minutes. Hosted by me, T.G. Watkins of Simpler Trading, the creator of the Moxie Indicator. Each week, I'll provide you details about the indicator, what it does, and how it can work for you. Only on StockCharts TV.
Hey, everyone. Welcome back to the Final Bar. It's such a pleasure to put this show on for you, and we really appreciate you joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis and the best practices of our discipline. A couple quick announcements before we bring on today's guest, Tom Bowley. First off, we welcome your questions. We had a short mailbag segment earlier this week. We're going to do a longer one on tomorrow's show on Friday, and we'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We are on Twitter @FinalBarSCTV, and we are on YouTube. Just bring us video up on your StockCharts YouTube channel. Put a question below the video you're watching. Hope to answer one of your questions live on the air on Friday's show. You can go to StockChartsTV.com. That is our on-demand platform. We have so much great content and ideas to share with you. Great guest discussions, special events like our Market Outlook. Larry Williams, Martin Pring both did their Market Outlook specials recently. All of that content is available for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. To let you know about our upcoming schedule, great guests today in Tom Bowley. Next week, we have 3 good guests lined up for you as well. On Tuesday, the 24th, Willie Delwich, who's the strategist at All-Star Charts, coming to us from the upper Midwest. Willie's a really good, fantastic strategist, long time at Robert W. Baird, and we'll bring some great charts along with him, I'm sure. Wednesday, the 25th, technical analyst and portfolio manager Katie Stockton from Fairlead Strategies. And then on Thursday, one of our more controversial guests, David Hunter, the contrarian, will be joining us on the show. We'll hear what objectives he has to the upside and the downside for the S&P 500. Finally, just to let you know, my next webcast with Market Misbehavior will be coming up next week on Tuesday, the 24th. I'll be presenting a special event called the Morning Coffee Routine. I'm going to talk you through the set of charts that I look at every morning. Literally grab the cup of coffee, fire up your laptop. What do you look at? And we'll talk about what is important to include in that morning coffee routine, what types of charts I look at, and help you to hopefully think about your own routines and your own charts that you review every day. You can sign up for that free event at marketmisbehavior.com/coffee. I want to bring on today's guest, Tom Bowley. Tom's been a frequent guest on our show, a guest host on StockCharts TV, and a longtime StockCharts contributor, and very well deserved. He's a chief technical analyst, or chief market strategist, at EarningsBeats.com. Tom, great to see you. Welcome back.
Thanks, Dave. Always good to be here.
So we are sort of getting into the meat of earnings season, and I know with your company, you guys do such a great job of thinking about the implications of earnings, anticipating earnings, but also the technical implications, which I love that balance of thinking about the fundamental and the technical as you're trying to make sense of things. As we are getting this earnings season started, can you set the stage for us? What is your perspective? We've had this run off the October lows. We're now stalling out a bit this week. What would you expect here in the coming weeks going forward?
Well, I think earlier when you were looking at the S&P 500, I think you kind of nailed it. I mean, I'm looking at the same levels you are, right around that 4,100 level in the S&P. I think until we can get through that, I mean, you can't get to that all-time high without breaking this downtrend and starting to create a series of higher highs and higher lows. And so I'm kind of looking at the same thing you're looking at. And the thing is, if you switch over to like a weekly chart, a long-term chart, you'll see that the 50-day moving average, or excuse me, the 50-week moving average is currently at 4,036. So that's also right in that area between 4,000 and 4,100. And then even switching out further and looking at a monthly chart. Right now, we're kind of trapped between the rising 50-month moving average, but we've been struggling to try and get back through that 20-month moving average. So literally all the time frames are all set up for this 4,100 test. And as bullish as I am, and I am bullish for 2023, I do recognize that we need to break through this level first. It might be with earnings. Personally, I think the first quarter could still be a little choppy, but if we can get that breakout, I think that would certainly open the doors to further gains.
I'm already regretting bringing you on the show, Tom, because I always offer to bring up charts as you're talking, and you are way better at stock charts than I am. So I'm trying to keep up the best I can, but you always make it a little more challenging. Now, as we've gotten started here, we have Netflix after the close today. We've already had some earnings, banks earlier this week come to mind with, Goldman and Morgan Stanley having some big moves around earnings. What sort of names are you looking at? What sort of groups are top of mind as you're sort of thinking about this week and going forward?
Well, as you know, a lot of the growth stocks have really struggled. The fourth quarter of 2022 was rough for a lot of the big aggressive sector names. I mean, Apple, Microsoft, even companies like Netflix, Tesla, they've really struggled in the fourth quarter. And it's going to be difficult for the market to make a meaningful push to the upside without some support from these bigger names. So one of the big names I was looking for, one of the big earnings reports for this earnings season, was the one that just was released a couple of minutes ago, and that was Netflix. I haven't seen the results. I don't know what they came up with in terms of their revenues and earnings per share and their subscribers and so forth. But they did get an initial positive reaction. I think the stock was trading up over 340 after hours. It has pulled back now closer to 325, but that is up still about $10 from where it closed. I think the big number on Netflix, I'd like to see it open tomorrow above 333. I think if it does, I think it's got a chance to run. And that would be one of those stocks that I think are going to be really important for the market to get going. Because if you look at relative strength, if you pull up Netflix on a relative basis and just look at it versus the internet space, its peers, it's actually one of the leaders. And I like to see leaders heading into earnings and then actually following through with nice reports. And we don't have a lot of really good looking charts in the internet space. So I think there's a lot of internet companies probably looking at this one, a lot of folks that like to invest in internet, looking at this Netflix report as maybe some sort of a barometer for what we might expect throughout the rest of earnings season from internet stocks. So I think Netflix is the first one to really hopefully get us going tomorrow.
Yeah, it's a really good example. Netflix currently, as we're doing this after the close, up about 4% after hours. But we'll see obviously a lot to come yet as they do earnings calls and so forth. But the relative strength, you mentioned Netflix relative to the internet space, which is sort of just below volume on the chart that you shared with us. Netflix is an interesting one because it's such an outlier relative to the other FANG stocks, right? It's sort of, you have the FANG names, most of which have been struggling mightily. Netflix has been the big outlier over the last 6 months. When you're looking at a chart like this, where, just generally speaking, where would you be? What would I want to ask? what would show you that something is wrong on this chart? Because Netflix strikes me as one of those names that's working. And I'm thinking of the bear case for markets would mean something like Netflix most likely comes down. How do you manage risk on a name like this with so much uncertainty in the broader market?
That's a great question. I don't know exactly how you manage risk on an individual stock like this. I'm sure you could have, there's several option strategies and so forth that you could maybe consider. But I mean, Netflix to me, when I think about the overall market, and I'm trying to look at big picture, whether I think the market goes up or down, because it's much easier to invest if you can get that big picture correct. And I do think that we bottomed back in October. One thing I think maybe listeners would be very interested in is that this is 2022 is the 14th bear market that we've had since 1950. And of the previous 13, 6 of them ended in the month of October. And you would just think, okay, we have 12 different calendar months. Why is everything cramming into the month of October? But if you look back to 2022, again, that was our low. So if that turns out to be the ultimate low, that will mark the 7th time in the last 14 bear markets that we ended the bear market in the month of October. I think that's kind of interesting.
Yeah, we had Jeff Hirsch on the show, a week or two ago, if I remember right, and talked a lot about the presidential cycle, the 4-year cycle, and thinking about the midterm election year, which was last year, and then the pre-election year, which is this year. Usually you have a bottom in, guess what, October of the midterm election year, which we really did. But then the next, 6 months from here tend to be pretty strong. You actually have tend to have a pretty good beginning of the year. So far, it's actually following the presidential cycle playbook as well, which is interesting. You mentioned a couple other groups that I'd love to get through, Tom. Footwear is an area like Deckers and others have had pretty good runs. Can you talk us through that group? What draws you there?
Yeah, I mean, this was one of those areas that in 2022 just could never get its footing. I mean, it just continued to trend lower, kept seeing lower lows, lower highs. And we had the gap down at the end of September in the footwear index. And to me, that looks like an exhaustive gap. I mean, I think that, we've been trending lower and lower. And a lot of times that's what you want to see. You want to see some sort of capitulatory move where it just looks like all the sellers have finally exhausted themselves. And I don't know if I could maybe paint a better picture of an exhaustion gap than looking at the end of September on the footwear index, where we gapped down. You can see that volume was just off the charts. And then we've had a steady rally since then. And so as we go into earnings season, one of my strategies really is to look to see what areas of the market are performing well, because that's where Wall Street is placing their bets, if you will, as you head toward, start moving toward earnings season. So I think here you've got a clear leader. Footwear has been very strong. And I know Nike's the big name there, but I actually prefer CROX and Deckers over Nike. I think both of them are showing better relative strength. Both of them have the ability, I believe, to grow their earnings faster. And so if rates do continue to drop, which we've been seeing recently, these are the kinds of names that if they can continue to raise guidance with lower interest rates, these are companies that could go up quite a bit. So those are two that are on my radar in this particular group.
Does it surprise you that a company like CROX or Deckers is doing so well with all the things we've been told about inflation and all of these issues? Retail is not one of those natural, obviously retail is going to rip to the upside, but you're seeing it with things like CROX and Deckers, seeing it with like Ulta and others. What do you make of the fact that retail doesn't seem to care that this is a bear market, right? And that inflation is such an issue. It seems like things are just fine, right?
Dave, this is why we do what we do, right? I mean, honestly, the charts are telling us a different story than what we're hearing in the news and the fundamentals. I look at a group like footwear. I look at a group like apparel retail, which is the DJUSRA. So if you pull that one up, that's going to be a very similar looking chart. All of a sudden, moving back to the upside in a recession or a potential recession, how strong do you think restaurant stocks would be? But if you pull up the DJUSRU, you'll see again another story being told by the charts. They're not being told on the news. So you got restaurants doing well. Why would restaurants do well if we're getting ready to go into a deep recession? Makes no sense, right?
The charts don't seem to care, right, whether or not it makes sense, right?
Right. I try to follow what I see on the charts because there's nothing, nobody's telling me this is where the money's going, and I like to see where the rotation's going, and that tells me more of a story than anything I could hear on the TV.
We only have about a minute left, Tom, but I do want to mention, I know in the market outlook special, and again, thanks again. That was a lot of fun. I'm super glad you were part of that. But we talked about sort of this general idea of value versus growth and how in this environment, generally speaking, value tends to do pretty well. Are there any sort of value-oriented areas of the market that you find compelling here, given what you're seeing?
Well, again, I'm bullish. I think rates come down. I think money rotates to growth. So, I mean, if I was going to do something with value, it'd probably just be in the materials and energy area. What we talked about with Mish and Greg in that market outlook show. Those areas are still working. Nice dividends, continue to be in uptrends. I mean, those would be the areas I'd be interested in.
I somehow we scheduled you with two hardcore commodity bulls. So thank you for giving us a well-rounded perspective on the market outlook, Tom. Listen, it's awesome to have you on the show today. Thanks again for joining us, Tom. Stay safe and be well there, and we'll talk to you again soon.
All right. Always a pleasure, Dave.
That's Tom Bowley. Tom's the chief market strategist at EarningsBeats.com. I did talk to him. Again, great discussion there and a lot of great ideas. He knows the industry groups that we use on StockCharts way better than I do. So he was rattling off tickers in a pretty cool way. But what I love about it, these charts that I was showing you, these are the templates that he suggested we use. And I love the focus on relative strength. Did you notice with every one of those things we brought up, Tom immediately at some point was talking about relative strength and what an important message that was. I find for a lot of investors, particularly individual investors, they underweight the importance of relative strength, the importance of recognizing which stocks, which ETFs are getting it done relative to any other name that you could pull a lever on. Great take there. By the way, he mentioned they have a special event coming up this Monday, 4:30 p.m. Eastern, to talk about earnings season. So if you want more information on that, go to EarningsBeats.com. We need to wrap the show and go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. I mentioned in our market recap about the breadth conditions and how they've improved. In an interview I did earlier today, I was asked about the breadth thrust, which has been a common question I've gotten here in recent weeks. What do you make of the fact that breadth has turned so constructive after being so incredibly negative in the third and fourth quarter of last year? I think that's incredibly meaningful. And for me, my first reaction is the strength and breadth off of the lows shows you how many stocks are participating. We highlighted today with Tom Bowley charts like CROX and Deckers. I mentioned Alto. We talked about materials names, industrials names. These are some of the stocks that have had pretty incredible runs off of the lows. But there are a lot of them out there. I'm not struggling to find pretty constructive charts. When I was scanning for stocks making new 3-month highs and 3-month lows, this was yesterday morning, I had about a 8 to 9 1-to-1 ratio in terms of new highs to new lows. That's more bullish than not bullish. However, I think you have to watch these indicators to see if they rotate back more to the negative side. One of the ways I use this chart is to see if the percent of stocks above their moving averages remains above 50% in this sort of environment. If it breaks below 50%, that's not just a blanket sell signal, but it does tell you that things might be changing, what I would call a change of character in the market. I think the downside risk to this market is we break 3,800. These indicators go below 50%. I don't know if that's going to happen, but I do know this chart will tell you what happens, because before we get to 3,200 or 2,500, we have to break 3,800 and 3,500. So let's focus on some of those key levels, set an alert for when we break them, and StockCharts can do some of the work for you. Chart number 2 is Southern Copper. We talked about our market outlook special, which Tom is a part of. Greg Schnell and Ms. Schneider were the other two. They did a great job talking about some of the strength that we're seeing in different parts of the market. We talked about a lot of different things, but particularly focus on the material space at one point. Southern Copper on the weekly chart is an interesting one to me. I think this somehow combines the incredible strength off the lows that you see from mining stocks. And again, this is a copper name, not a gold name, but you see the rally off of the low, in this case in September, the surge in relative strength. This is Southern Copper versus the S&P SPY on the bottom, but look how it's rallying up to resistance. So we've had a really good run, but we're rallying up to a key resistance level. To me, that brings a bit of a question mark. Is there enough momentum to get to new swing highs to show that buyers are not just taking it to resistance, but through resistance? That's what I'd be looking for. Final chart, long-term chart of gold, right? If you look back to the 2011 high, look at the 2020 high, the 2022 high, we're kind of pushing right back up to there. Can we get above 2,100 this time? Let's see. Folks, that's a wrap for this show. Thanks so much for joining us every weekday after the close for the final bar. Special thank you to Tom Bowley from EarningsBeats, joining us from Virginia. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.